This is Viewpoints by Hennessy, a podcast featuring the latest thinking from the team at Hennessy Funds. My name is Jay Coulter, and joining me for this update on the Hennessy Japan Fund is Masa Takeda. Let's get right to it, Masa. Earlier this year, Japan's central bank raised its benchmark interest rates for the first time in 17 years, ending a long-standing policy of negative rates meant to boost the economy. What's your assessment of this move?
Well, I think the Bank of Japan has done it smoothly, and that's good news. You know, Bank of Japan they had made mistakes in the past by prematurely raising rates or lifting the zero rate policy, so-called. And that was back in 2000 under the then Governor Hayami, and 2006 to 2007 under Fukui. And each time it pushed the Japanese economy back into recession, and deflation worsened. And so I think the current governor, Ueda, wants to err on the side of higher inflation. And so that means Bank of Japan will continue to operate by looking in the rearview mirror, rather than curbing inflation preemptively. And so the monetary policy framework will continue to remain accommodative, even though overnight core rates moved from minus 10 basis points to 0 to positive 10 basis points. Given the current inflation rate, the negative rate, real interest rates are still negative. And also even on the long end of the curve, given the inflation indexed government bonds, the current inflation expectation is 1% plus, while 10-year JGB, the yields are right now is less than 1%. So again, interest rates are negative there as well.
So does Japan still have a goal of 2% inflation, and how will this impact that?
Yes, absolutely. So the goal of inflation 2%. I generally believe Japan's inflation will be higher for longer. So initially, about 2 years ago, the inflation was triggered by pretty much when Fed started raising rates. And that caused the interest rate differential between the yen and dollar to widen. And it raised the import prices for Japan, and that created inflation. And also supply chain disruptions also was part of the reason for inflation at the start. Now the baton is passed to more structural forces like labor shortages. In Japan, we're facing demographic challenges, as you know. The peak population, total population for Japan, a little bit over 120 million people, but that already peaked out in 2008. The last 10 years, thankfully, we had rehiring of senior workers, retired workers, and increasing participation by women in the labor market, and that helped the overall labor population to stay flat. But that is going to run its course, and so wage inflation will likely continue going forward. And also we have inbound tourists that are also causing inflation, and inbound foreign direct investments by the likes of TSMC building factories here. That's also causing inflation in different parts of Japan.
Masa, how is all this going to impact equities going forward, in your opinion?
Right. So I think the nominal rate is positive, yet real interest rates are negative, and therefore that's good for the equities. I think going forward, if Japan can withstand higher inflation, meaning if Japan does not fall into stagflation, then Bank of Japan will continue to raise rates, and if Japan can absorb rate hikes, then we're going to have a situation where nominal interest rates will continue to rise with the overall monetary policy framework being accommodative. And so I think that's, to me, it's kind of like a Goldilocks scenario, and it's particularly good for financials because we are having an environment where the inflation, it's a good inflation rather than bad inflation.
All right. So the yen has dropped 50% against the dollar since 2012. As you assess the yen going forward against the dollar, what are the implications for US based investors in Japanese equities?
Well, so I think the cheap yen is here to stay. Um, there are several reasons why the yen has depreciated. Um, for one, um, again, it's the rate argument. Japan is one of the few, if not the only country with negative interest rates today. And that means currency-wise, JPY is less favored, or you can raise in yen and sell yen and invest elsewhere, higher interest rate currencies or assets. The other thing is the Japan's trade balance or current account balance has changed dramatically in the last 20 years. In the past, Japan, known as the biggest exporter of the world, there was a constant need for yen purchase by exporters in Japan. So that created upward pressure on the yen. However, over the years, these exporters, they built factories overseas, and when they generate profits, a lot of that get retained locally and reinvested and hardly repatriated back to Japan. So even though current account balance today is a surplus, on a cash flow basis, the demand for the yen is far less. Now, I do think that in this environment, the best way to invest in Japan is to invest in high quality global blue chip companies that are domiciled in Japan, because Japan, on the macro level, they face many different structural challenges. But if you look under the hood, there are a lot of world-class, high-quality companies that can compound capital for investors with big moats, with huge total addressable markets. So I think that's how people in the U.S. should allocate and invest.
So then, from your portfolio manager seat, how are you managing inflation that is seen across the globe? Are there implications to the strategy you run?
Right. So inflation obviously affects our portfolio, in two ways. So number one, inflation damages our portfolio company, the business's profitability. And also, inflation usually leads to higher interest rates, and higher interest rates can depress the valuation multiples of equities. Now, how we are dealing with this situation? Well, we are, being pure bottom-up stock pickers. We try to identify companies with strong pricing power, with big economic moats, and we are also much more sensitive about valuations, far more sensitive than, let's say, during 2010s when Japan's structurally low rates seemed like it would last forever. So both the valuation discipline and continued focus on high quality, durable franchises.
In our interview last year, you had mentioned that tourism is a major factor in the Japanese economy. What can you tell us about the tourism impact over the past 12 months?
It's definitely progressing well. I think we are moving ahead of expectations, and that's good. According to JNTO, which is Japan National Tourism Organization, first 3 months of this year, the tourist arrivals, international arrivals, we had about 8.6 million people. And just by looking at March alone, our run rate is currently about 36 million people for the whole year, and that's higher than 2019 peak. The previous peak was about 32 million people. So that's that's a big growth there, and people are mainly coming from Korea, Taiwan, as well as U.S. and Europe, even in the absence of meaningful recovery from China. And better yet, per tourist spend is also increasing nicely, currently 40% higher than 2019 peak, thanks to the inflation, mild inflation, and rising prices. But still, in the eyes of many foreign travelers, I think Japan is extremely attractive in terms of affordability.
Let's pivot and talk about the portfolio. So, why do you currently have such a heavy overweight to the financial sector?
So we're not doing top-down allocation. This is just a result of pure bottom-up stock picking. And within financials, we think our portfolio is highly diversified. We have 3 general insurance names. We have 1 big mega bank. We have financial services company called ORIX. And then we have Japan Exchange Group, which is the operator of Tokyo Stock Exchange. So these are very much differentiated businesses from each other. Each investment case has structural thesis to it. For example, ORIX is a financial services company, but it's more like an investment company with some valuable assets like Kansai International Airport. So it's a hidden beneficiary of inbound tourism, in my view. The beauty of these names in insurance, banks, ORIX and so on, is that they are labeled as value in the market. We view them as growth. These companies have been compounding at mid-single digit rates to high single digit rates, which is higher than world nominal GDP. To me, it's growth. And because of the perception that it's value, the share price levels are generally low, which means they have high dividend yields, higher than average dividend yields of about 3 to 5%. And then they have asset-rich balance sheets, which allow them to do consistent share buybacks, 1 to 2% of outstanding shares. And so if you add them all up, the core earnings growth, dividend yields, and share buybacks, you get 10% plus expected returns as a shareholder, which is almost comparable to some of the pure growth names that we had held much of 2010s. And in this environment, I believe we call them growth stocks in disguise. These financials, we think they are sensible. I guess these investment decisions are very sensible in today's environment.
All right, so you're a bottom-up stock picker, sector agnostic, but are there any sectors today in Japan that investors should be wary of?
Well, so short term, we have been overweight in semiconductor industry. We initiated investment in semiconductor-related names back in 2022, October, when there was U.S.-China chip war. And that gave us a rare opportunity to take big exposure. And I think semiconductor industry overall is attractive. It's secular growth story and so on and so forth. And in Japan, there are a handful of dominant players in their respective fields, be it semiconductor equipment, silicon wafers, specialty chemicals, and even chip making itself. And we've had a great run, and to a point where some names have become a little bit overheated, at least from a short-term perspective. But I do believe that there are still other names that are trading at attractive valuations. And if you take a long-term view, all the names have promising outlook. So short-term, yes, slightly cautious, but we remain bullish long-term.
Let's close with your thoughts on a couple of names in the portfolio. What could you share with us about Tokyo Marine?
Right. So we have, as I said, including Tokyo Marine, 3 insurance companies, general insurance companies, and there are only 3 listed. So we own all of them. The reason why we like them, I believe Japan's general insurance industry is attractive. Most people think it's boring, low growth, mundane. But if you look at the structure of the industry, again, there's only 3 players controlling about 90% of the market. And as a result, they have strong pricing power and combined ratio of less than 100%, which means they are very much profitable. Now, there's no other insurance industry like this outside Japan, as far as I know. The other thing is these insurance companies have extremely asset-rich balance sheets. It's called policy shareholdings, which is basically shares of their corporate insurance clients that were acquired back in 1960s in order to develop business relationships. But today, business relationships are not based on the presence of these shareholdings. It's based on merits. And so these are underutilized assets today, and they are liquidating. The managements of these companies are liquidating these shareholdings, $1 billion, $2 billion each year to fund their overseas growth, as well as returning capital to the shareholders. And so they're in an extremely strong position to do these things. And again, in no other countries do we see this kind of insurance industry. We believe Japanese insurance companies are extremely attractive, and they are available at very attractive valuations as well. High single-digit multiples at the time of our investment, high dividend yields, and even price to book less than 1 time.
And then what about your holding 7NI Holdings?
Right. So as an individual stock, 7NI Holdings is one of the overweighted names, and it's a convenience store business. It's a retail conglomerate with a focus on convenience store operations, both in Japan and in the U.S. And as a matter of fact, it's a global business. So there's a significant scope for global expansions as well. Now, in Japan, convenience store business itself actually originated in the United States. And then back in the 70s, Japan's Ito-Yokazo acquired 7-Eleven. And the convenience store as a business evolved over the next several decades. And I think that convenience store business is arguably one of the most powerful retail formats. It caters to people's daily necessities, so it's recession resistant, high returns on capital, cash flow generative. Now in Japan, it's now largely it's become saturated. 3 players, just like in the insurance space. We have 7-Eleven, Family Mart, and Lawson. But over in the U.S., they made a large acquisition called a company called Speedway, and with that acquisition, they became number 1. And U.S. convenience store industry is still fragmented. And Seven & I Holdings is currently number one with 10% market share. So there's a huge runway for growth. There's significant opportunities for roll-ups as well as organic expansion. So we like Seven & I, and evaluation, again, it's because of Japanese accounting standards, the current EPS is understated. We think its price to earnings is currently about 12 to 13 times, with free cash flow yield of about, it's close to 10%. So it's extremely attractive valuation as well.
Excellent. Masa, thank you so much for coming back on Viewpoints by Hennessy. Viewers, to learn more about the Hennessy Japan Fund and all the funds at Hennessy, visit hennessyfunds.com.